Good morning, everyone, and welcome to Bulls, Bears, and the Bell.
This is your deep dive for Tuesday, November 18th, 2025.
Our mission today is to go far beyond just the surface readings of yesterday's market action. We're doing an absolutely crucial dissection of Monday, November 17th.
It was a session that, well, it delivered a really sharp, decisive trend lower.
Exactly, only to have its entire narrative just completely upended by a massive after-hours revelation.
That's right. We've gone through a stack of source material after-action summaries, quantitative research, detailed market internals, all to extract the most actionable insights for you as you get ready for today's open.
And this isn't just a recap. You should really think of this as an early warning system.
It is. The conflict we're facing is just so stark.
It really is. Monday was a definitive fade the rally day. It was characterized by deep technical damage, high distribution, and just this entrenched risk-off sentiment.
A day where sellers were in complete, total control, no question.
But then, after the closing bell, we get this massive counter-narrative.
Courtesy of a 7% surge in Alphabet, GOGL.
Right, following a major institutional investment disclosure.
Yeah.
It just throws everything into question.
This divergence, it really throws the entire Tuesday open into sharp relief. We need to figure out if that GOGL jump is a temporary spike to sell into, or if it represents, a fundamental validation of big tech that can genuinely neutralize the bearish shift we saw yesterday.
And the broader context here is that tension, isn't it? The tension between strong macro data,
like the Empire State Report,
and this really concentrated technical selling, especially in those rate-sensitive sectors.
It really suggests the market is fighting itself over the very definition of good news.
So let's unpack the Monday session, starting with that primary takeaway. We really can't overstate the acceleration of selling. While the S&P 500's final loss, might seem manageable on paper, the crucial feature of the day was that culminating risk-off distribution.
And it intensified so dramatically in the final 2 hours.
It did. Yeah. It just confirmed that the bearish conviction was growing, not shrinking, into the close.
It was a textbook example of institutional de-risking. 100%. We saw that immediate rejection of the morning's bullish attempt.
Right at the open.
Followed by a persistent decline all day. And, let's look at the index performance. Because the pain was not evenly distributed, it targeted very specific, very sensitive parts of the market.
Okay, so where did the selling hit hardest?
Well, the clear quantitative canary in the coal mine was the Russell 2000, the RUT.
The small caps.
Exactly. It dropped a staggering negative 2%. It lost 46.85 points.
Wow.
And look, this is far more than just a bad day for small caps. It is the loudest signal of distribution we received all day.
So let's break that down. Why is the RUT's 2% drop so much more alarming than, say, the S&P 500's smaller loss? We need to explain that mechanism for everyone listening.
Absolutely. The RUT represents a basket of small-cap companies, and they are inherently more sensitive to the cost of capital.
More so than the large, cash-rich mega-caps.
Far more. Unlike the FANG stocks, which have these vast internal cash flows, smaller companies often rely heavily on accessible, cheap credit.
For everything from expansion to just day-to-day operations.
Right, for expansion, for refinancing, for operations. So when traders start to aggressively price in a prolonged period of high interest rates, that higher for longer narrative we keep hearing about, the entire financing structure for these smaller, often highly leveraged firms, it comes under severe stress.
So a 2% single-day drop is the market basically confirming that traders are projecting genuinely painful implications for the RUT's companies.
That's it. It's all about the shift in Federal Reserve rate expectations. It's a full-scale flight from riskier balance sheets.
That context just makes the move so much more impactful. Meanwhile, the benchmark S&P 500, the SPX, closed down negative 0.92%.
Shedding about 61.70 points.
And this nearly 1% loss, it confirmed a pretty serious technical failure, right? It returned the index to a bearish structure after failing to sustain those prior support levels.
It did. And looking at tech, the Nasdaq Composite, the CMP, it closed down negative 0.80%.
A loss of about 192.51 points.
Now, while it statistically outperformed the S&P 500 on a percentage basis, what we saw when we dug in was that this was driven by a heavy rotation out of high beta smaller technology names.
Even as the largest mega caps showed some relative resilience, until that final hour at least.
Exactly, until the final hour.
And finally, the Dow Jones Industrial Average, the DJIA.
It closed down negative 0.70%, losing 309.74 points.
And that just confirms the selling pressure was broad-based. It was affecting even the traditional blue-chip components.
The lack of any material defensive rotation within the Dow itself suggests the selling wasn't localized. It was pervasive. It was across all capitalizations, signaling just, generalized caution.
Okay, so now we drill into the session timeline, because the when is just as important as the what. We had to start with that false hope right at the open.
A failed morning rally.
Between 9:30 a.m. and 10:30 a.m. Eastern.
It was a classic opening drive set up for failure. I mean, pre-market futures had suggested a bounce, an attempt to gap fill and stabilize, but the moment the opening bell rang, the rally just stalled.
And where did it stall?
It immediately encountered firm resistance precisely at the prior day's close level, the PDC. For the S&P 500, that was 6,734.01.
And the PDC, that's often the psychological line in the sand, right? It's the level where last week's buyers or sellers established their positions.
That's a perfect way to put it.
So failing to sustain a move above that 6,734 level means the market just couldn't convince new money to step in with any real conviction.
Exactly. And this translated into a clear opening drive fade. Sellers, who were just positioned right above the PDC, they quickly reversed that early momentum.
So we reversed course pretty rapidly.
Oh, very rapidly. We moved straight back to test the pre-market lows. It was a swift, high-conviction rejection right from the get-go.
And that rejection led us straight into what the reports are calling the midday trap.
Yes, running from about 10:30 a.m. to 2:00 p.m. Eastern, the market stabilized briefly, creating a lateral consolidation.
So how should listeners interpret that kind of sideways movement? Is it a base being built or something else?
Well, in this case, it was a classic trapping mechanism.
A trap.
Yes. The minor stabilization created this consolidation channel, and it lured in late buyers.
The optimist.
The optimists, exactly. The ones who saw the rejection but thought, okay, the big money will step in here and turn the tide. But the market was completely unable to reclaim and hold above the volume-weighted average price, the VWAP.
Okay, let's pause there for a moment. For listeners who don't track intraday metrics like that, what exactly is VWAP and why is its role as resistance so critical here?
So VWAP is, it's essentially the true average price a stock is traded at throughout the day, but it's weighted by volume.
So it shows where the real money is trading.
Precisely. And because it incorporates volume, it is the benchmark that's used by large institutional traders, mutual funds, pension funds, you name it, to measure their trade execution quality. So when the index remains below the VWAP for an extended period, which is what it did during this whole consolidation, it signals institutional passiveness on the bid side.
So in simple terms, the big money just wasn't interested in buying at that price.
They were not. And without that institutional bid, the path of least resistance remained definitively down.
And that path intensified dramatically in the late-day distribution phase, from 2:00 p.m. to 4:00 p.m. ET.
Yes, the selling pressure just accelerated, and that confirmed the trend down day.
This was the capitulation phase then.
It was. The S&P 500 definitively sliced below the low end of that midday consolidation range.
Triggering stop losses.
Triggering stop losses and forcing all those trapped late buyers to liquidate. This acceleration confirmed the day's entire structure. And the Russell 2000's performance during this 2-hour window, as we noted, was the clearest quantitative signal that the financing risk fear was really reaching a climax.
And the most definitive closing signal. We closed right at the absolute lowest point of the session.
On the button. The S&P 500's final mark was its intraday low, 6,672.41.
And that closure, right on the low of the day, it just suggests zero buying interest emerged to absorb that selling. Sellers maintain control until the absolute last tick.
And critically, that closing price also broke a major intermediate-term technical level.
This is the 50-day.
This is the 50-day moving average, the 50 DMA, which was estimated right near 6,681.00. It was tested and it failed on a closing basis.
Okay, explain the significance of the 50 DMA failure. Because it's more than just a line on a chart, isn't it?
Oh, it's far more. The 50 DMA represents the average closing price over the last 2.5 months of trading. It's really the key indicator for medium-term trend health.
So when a major index like the S&P 500 closes below its 50 DMA,
it signals that the recent uptrend structure has been decisively violated. This move below the 6,680 zone technically shifts the intermediate outlook from neutral, or maybe even bullish, to definitively bearish.
And for technical traders, this break triggers a cascade of potential actions.
A huge cascade. It forces them to account for the very real possibility of a quick move down toward the next major support levels.
The 100-day, the 200-day.
The 100-day and eventually the 200-day moving averages. The break of the 50 DMA suggests that momentum has flipped and it forces trend-following strategies to liquidate, which just fuels the move lower. It's a key psychological and algorithmic trigger point.
All right, so we've established the technical damage, but what was the engine driving this widespread de-risking? We have to reiterate that the core fundamental catalyst was the enduring uncertainty around future Fed policy.
That is the anchor of the bear thesis. The severe weakness in the RUT, as we discussed, is the market's hard evidence that traders are aggressively pricing in a prolonged period of high interest rates.
So this isn't just a concern about if the Fed hikes again.
No, not at all. It's about how long they intend to keep rates restrictive to combat the sticky inflation that just won't go away.
And supporting this fear, we had some weak microdata, specifically the decline in small business confidence.
Correct. The Small Business Confidence Index fell. And this is a powerful supporting data point because it comes directly from the entrepreneurs and small enterprises that are really the backbone of job creation.
So a fall in their confidence signals deteriorating domestic economic prospects.
Exactly. It's a bearish read-through that immediately compounds the risk of high borrowing costs for the entire RUT complex. Traders saw this data and used it to justify their flight from growth.
And the market, it seems, completely disregarded the minor counterpoint, the modest 0.2% rise in construction spending.
It did, because the market is focused on the future. Construction spending is often a lagging indicator, It's reacting to decisions that were made months ago.
Right.
So when you're faced with a choice between an immediate fall in forward-looking business confidence and this persistent existential threat of high borrowing costs, well, lagging good news doesn't stand a chance.
Okay, and this is where the confusion really peaks. The macro divergence driven by the Empire State Manufacturing Index. This report was surprisingly strong.
This is the centerpiece of Monday's confusion, and it's a critical concept for listeners to grasp. The Empire State Manufacturing Index posted a huge beat. It came in at 18.780.
And the consensus was only 6.0.
Only 6.0, and the previous reading was 10.70. So this is a very strong manufacturing reading for the New York region. It signals robust activity, and it bolsters the narrative that the U.S. economy is resilient, perhaps on a soft landing or even a no-landing path.
Okay, so if the economy looks strong, why did the S&P 500 sell off? Why did the indices punish a strong data point? This is what confuses so many people.
This is the complex relationship that defines the current market environment. The strong data is interpreted as inherently hawkish.
Good news is bad news.
Good news is bad news. The sell-off suggests the market fears that this economic strength gives the Federal Reserve the cover and the justification they need to maintain their restrictive policy stance, the high rates, for much longer than anybody anticipated.
I see.
Remember, the Fed's dual mandate is inflation and employment. So if the manufacturing sector, as shown by this report, is robustly expanding, it suggests that economic demand is high, which prevents inflation from falling quickly back to that 2% target.
So the market says, good news on growth is bad news for my stock portfolio.
Essentially, yes. It's bad news for equity valuations because it forces the Fed to keep the discount rate high. And this fear of higher for longer just aggressively overrides the good news about economic resilience. It is a true catch-22 for equity investors right now.
And to complete the macro picture, let's look at the fixed income signal. The 10-year Treasury yield was stable, right? 4.14%, only declining a marginal 1 basis point.
Which is, for clarity, 0.01%.
Right.
And that stability is crucial context. If this were a full-blown systemic a macro event driven by fear of a complete economic collapse, investors would be aggressively rushing into the safety of long-term government bonds.
Driving the price up and the yield way down.
Dramatically down. The fact that the 10-year yield was essentially flat reinforces our earlier point. The equity weakness was not a systemic flight-to-safety macro panic.
It was more targeted.
It was a targeted technical de-risking and sector positioning adjustment, primarily concentrated in those high beta names and small caps. It validates the idea of concentrated pain rather than broad contagion.
Okay, so to truly gauge the health and the depth of Monday's liquidation, we have to examine the market internals. Let's start with the extreme breadth weakness. Was this selling limited to just the biggest stocks, or did it affect the whole market?
Oh, it was alarmingly broad. The depth was really indicative of a liquidation event. The NYSE Advanced Decline line, which measures the number of stocks advancing versus declining, is estimated to have closed with a net decline of approximately minus 2,400 issues.
Minus 2,400. A net decline of that magnitude suggests a severe, almost capitulation-like breadth issue.
It does. A net decline that exceeds negative 2,000 is a statistical rarity. It signals a broad-based liquidation affecting nearly every corner of the market, not just the large index constituents. This quantitative fact, it just confirms the severity of the S&P's move and validates that narrative of deep market impairment.
That level of selling usually equates to panic. Did the trend confirm that emotional state?
It did. The TRIN, often called the ARMS index, it closed at a critical elevated level of 1.85.
And TRIN is it's a crucial indicator that measures the ratio of advancing volume to declining volume.
Relative to the ratio of advancing issues to declining issues, yes.
Okay, so can you explain in simple terms why a 1.85 reading signifies panic?
Of course. A TRIN value above 1.0 means that the volume going into declining stocks is greater than the volume going into advancing stocks.
Okay, that makes sense.
So a value significantly above 1.5, like 1.85, is considered a strong signal of panic selling because it confirms that selling pressure is just overwhelming the buying interest. The high reading confirms an oversold condition, meaning the market has been pushed down aggressively in a very short time frame.
So tactically, what does that high TRIN reading imply for the session ahead?
It suggests exhaustion. In technical analysis, values near 2.0 often mark short-term selling climaxes or bottoms.
The point of maximum pain.
The point of maximum pain. When the panic reaches this level, most of the traders who were forced to sell, the weak hands, they've already been shaken out. So this high conviction oversold signal sets up a high probability for a mean reversion trade or a relief bounce on Tuesday.
However, there's a vital divergence that tempers that panic signal a little bit.
Yeah.
The NYSE tick. It was negative, but not as extreme as the trend would suggest.
This is a really nuanced point that separates the retail panic from the institutional flow. The NYSE tick closed at negative 950.
And the ticky tracks the number of stocks trading on an uptick versus a downtick at any given moment.
Exactly. For a day with such severe breadth, like minus 2,400 issues and a high TRIN of 1.85, professional traders typically expect the end-of-day tick reading to fall much, much lower.
Like minus 1,500.
Often hitting minus 1,500 or even lower, signaling outright disorderly capitulation.
So the relative divergence, closing at minus 950 instead of, say, minus 1,500, what does that suggest?
It suggests that despite the intense selling pressure throughout the day, a measurable degree of institutional support, or maybe some organized short covering, stepped in during that final hour of liquidation.
So the selling was heavy, but it wasn't disorderly.
That's the key. It hints at some underlying buying interest that was there to absorb the market's final push lower, and that tempered the outright panic signal.
Let's confirm the emotional state using options data. The VIX and the put-call ratio. The VIX closed at 19.93.
The CBOE Volatility Index, the VIX, it rose about 0.5% to close at 19.93. This confirms there's rising anxiety and hedging demand.
But importantly, it stayed just under that critical 20.000 psychological threshold.
And that's key. Crossing 20.00 is often cited as the definitive break into a full fear regime. The fact that it held just below suggests high alert but not full market fear yet.
But the put-call ratio suggests definite fear.
Oh, yes. The total put-call ratio, or PC, spiked materially to 1.25. That is a significant jump from the previous close of 1.04.
And this ratio measures the volume of protected puts traded versus aggressive calls traded.
Right. So a spike over 1.21 confirms a strong, fear-driven shift toward hedging. Traders are aggressively demanding portfolio insurance. They're buying 1.25 puts for every 1.0 call they buy.
And just like with a T-on, this heavy hedging carries a contrarian tactical implication.
Precisely. This elevated PC ratio is a classic contrarian indicator. When a large contingent of traders has already purchased protection, they're less likely to be sellers in the immediate short term because, well, they're already hedged.
It exhausted their fear.
The exhaustion of fear is a strong signal suggesting a high probability of a relief rally in the very near term. Both the CHR and the PC ratio are pointing toward the same conclusion. The market is deeply oversold and poised for a potential bounce.
Okay, the technical damage was widespread, but the sector and factor performance shows a really clear divergence signal. We saw a massive 427 basis points spread between the strongest and weakest sectors.
427 basis points.
That's 4.27% difference between the winner and the loser on the day. That is a violent rotation.
It is the clearest sign of capital flight from risk that we've witnessed recently. Capital was desperately seeking safety and preservation. Let's look at the defensive leadership, the only winners on a day when almost everything else was being liquidated.
Where did the money hide?
Utilities. The XLU was the only sector to post a positive return, closing up 0.35%.
And that is a classic textbook signal of extreme risk aversion.
It's as classic as it gets. Utilities are essential services, they're stable, low growth, and their dividend yields act like a bond coupon. When money rushes into XLU, traders are executing a pure bond proxy trade,
signaling they prioritize safety and reliable yield over all other risk exposure.
Absolutely. And right alongside utilities, consumer staples, XLP, showed incredible resilience. It closed down a negligible negative 0.08%. Basically flat. And the strength of XLP confirms that rotation into inelastic demand sectors. These companies sell necessities, food, beverages, household goods.
Products consumers buy regardless of a weak economy or high rates.
Exactly. Their resilience confirms that traders are flocking to predictable earnings and high-quality balance sheets, confirming a deep structural anxiety about forward economic growth.
Now for the laggards, the REIT-sensitive sectors that drove the S&P 500 loss. They were hammered, starting with the largest sector, information technology.
Information technology, XLK, was the largest detractor by a significant margin. It closed down negative 2.30%.
And this is the quintessential sell-off in long-duration assets.
It is.
So let's elaborate on long-duration assets. Why is tech so sensitive to interest rates?
Okay, so think about the valuation of a high-growth tech company. Most of its expected earnings, and therefore most of its current valuation, are based on profits projected 5, 10, even 15 years into the future.
Way out on the curve.
Way out there. So to calculate today's value, those future earnings are discounted back to the present using the prevailing interest rate structure.
So when interest rate expectations rise, meaning the discount rate increases,
the present value of those distant future earnings collapses. The entire valuation mechanism for high multiple growth stocks just falls apart in a higher for longer environment. This fundamental sensitivity is what caused XLK to be liquidated so aggressively.
And right behind tech was consumer discretionary.
Consumer discretionary XLY followed closely, closing down negative 1.92%.
This sector contains companies selling goods and services consumers want but don't need.
Right, so it's doubly sensitive. It's sensitive to future interest rates, which impact mortgage costs, auto loans, general consumer credit, and it's sensitive to overall consumer health and confidence. A double whammy.
And our sources highlighted a specific mechanical drag here, the outsized impact of the mega-cap tech stocks.
Indeed. Due to their enormous size and index weighting, the aggregated selling pressure in the Magnificent Seven large-cap tech names was the single largest mechanical drag on the entire S&P 500.
So even if other parts of the market were okay, these stocks can pull everything down.
That's the point. While the overall sector action, XLK, down over 2%, confirmed broad tech weakness, the sheer weight of these few stocks amplified the entire index's loss. A sustained rotation out of these names would structurally challenge the ability of the S&P 500 to generate positive returns, even if other sectors improve.
Beyond just sectors, the factor performance gave us quantitative proof of this risk aversion. Let's analyze the beta spread.
This provides the most unambiguous proof of the market's defensive posture. We contrast the high beta index, ticker SPHB, which tracks the market's most volatile stocks, against the low volatility index, SPLV.
Okay.
The high beta index fell a severe negative 2.15%. Crucially, the low volatility index posted an outright positive return of positive 0.22%.
Wait, on a day when the main index fell nearly 1%, low volatility stocks were up. That's remarkable.
It is statistically undeniable evidence of capital flight. The resulting 237 basis point spread between high beta and low vol is statistically significant proof of an immediate severe decompression of risk.
Traders are aggressively degrossing speculative positions.
Exactly. That's the high beta route. And they're moving capital into the safest equity tranche available. The mandate is clear. Reduce risk exposure now.
And the style rotation confirms this rate dynamic further.
It does. Value, SPYV, closed down just 0.35%, significantly outperforming growth SPYG, which fell 1.45%.
That's a 110 basis point outperformance for value.
A huge gap. And it's because value stocks, with their lower price to earnings ratios and more immediate cash flow, are less susceptible to the negative mechanics of rising discount rates. The higher interest rates go, the more penalizing the environment becomes for growth companies, and that leads to this predictable rotation.
So synthesizing all this analysis, what is the critical conclusion regarding market leadership right now?
The day marks a critical inflection point where leadership has decisively shifted from growth and momentum to defensive and quality.
So utilities and consumer staples.
Exactly. The market is no longer rewarding speculation or long-duration growth assets. It is rewarding stability, resilient business models, and high-quality cash flows, all exemplified by the outperformance of utilities and consumer staples. The structural mandate for professional traders entering Tuesday is to maintain that defensive tilt until the rate picture clarifies.
Okay, now we have to address the elephant in the room. The after-hours development that complicated this entire bearish picture we just painted. The closing bell rang, confirming distribution, but then we got the GOGL bomb.
A massive market-moving surge in Alphabet.
This GGL event is the single most critical variable influencing the Tuesday open, isn't it?
Without a doubt, Alphabet Inc., GOGL, surged approximately 7% after hours. And the catalyst wasn't earnings.
No, it was the surprise disclosure of a significant investment by Berkshire Hathaway.
Commonly referred to as the Buffett bump.
So why does a single stock move, even a big one, in a mega cap company, have an extremely high influence on the entire market outlook? Why could it potentially neutralize all the broad-based damage from Monday?
It's a matter of psychology, size, and thematic validation. First, GGL's market cap is so massive that a 7% jump translates into a huge positive points impact on Nasdaq and S&P 500 futures. It forces those indices to start significantly higher than their bearish Monday close.
Right.
Second, and more importantly, this move acts as a clear, high-conviction risk-on signal for the entire big tech complex.
So it's about the narrative.
It's all about the narrative. Think about it. The market sold off tech yesterday, specifically because of the fear that high rates punish growth valuations. Then, the most risk-averse, value-focused, and historically successful investor in the world, Warren Buffett, steps in and validates big tech's long-term valuation by making a huge public investment.
It suggests to a lot of traders that the technical rate-driven sell-off in XLK was just an emotional overreaction.
That's exactly it. It provides a potent fundamental counter-argument against the prevailing rate fear and thus has the potential to completely neutralize the negative bearish tone that was established by Monday's close.
So GOGL provides the major bullish counter-narrative. On the other side, on the idiosyncratic short side, we saw a high-conviction short catalyst in LifeMD.
That's right. While LFMD's impact on the overall index is, negligible, its story is a strong warning for the speculative high-growth space.
What happened there?
LFMD plummeted approximately 16% after hours. This steep decline was triggered by a disappointing Q3 earnings report and, crucially, a substantial lowering of its full-year revenue guidance.
What were the specific numbers on that guidance cut?
The company gave a Q4 revenue outlook of $45 to $46 million. The analyst consensus estimate was $63.07 million.
That is a massive miss.
It's a near 30% cut in forward guidance. It signals severe near-term business headwinds and just a total lack of visibility. It really acts as a warning for the highly speculative telehealth and digital health space. It reinforces the Monday theme that high-growth expectations in speculative names are being aggressively re-rated and penalized heavily for any execution failure.
Okay, looking ahead to Tuesday, the economic calendar holds the key. We have critical inflation data right at the open.
Absolutely. The primary risk event is at 8:30 a.m. Eastern. It's the import price index month over month for October. The consensus forecast is for a gain of 0.1%.
And this data is crucial because it gives the market immediate information on imported inflation, a major component of overall pricing pressure.
That's right. The market reaction scenarios here are highly binary. It all depends on this number.
So let's detail those scenarios. What happens if we get a hot print, say, above plus 0.2%?
A hot print immediately triggers a forceful reignition of that higher for longer narrative. We would expect a quick 25 to 50 basis point spike in the 10-year yield.
And the dollar.
The US dollar index, the DXY, would test key resistance levels as higher rates make the dollar more attractive. And for equities, they would immediately retest Monday's lows with a high probability of a momentum-driven break lower. It would quickly negate the GOGL bump as macro fears just overwhelm stock-specific good news.
Conversely, what if we get a cool print below 0.0%?
That is the optimal scenario for risk assets. A cool print suggests imported inflation is receding, and that alleviates pressure on the Fed.
So the 10-year would drop.
We would see a quick 5 to 7 basis point drop in the 10-year yield, sending the bond complex aggressively long. This would fuel a sustained risk-on environment, allowing the Nasdaq to challenge prior resistance levels, with the GOGL surge providing the perfect fundamental tailwind for technology.
And following closely at 9:15 a.m. Eastern is the industrial production data, also with a consensus of plus 0.1%. Why does this report matter when inflation is king?
Industrial production is our key check for recessionary risk and growth health outside of the consumer. A print at or above consensus, it just maintains the narrative of a resilient, though likely decelerating industrial sector.
But a big miss would be a problem.
A significant miss, say, a reading of negative 0.5% or worse, would significantly raise serious recessionary risk flags. That kind of print could override even a cool inflation number and trigger a defensive flight to safety trade, favoring defensive sectors like utilities and crushing cyclicals.
And finally, we have bellwether earnings reports before the market open that will provide immediate microcatalysts, starting with Home Depot.
The Home Depot, HD, is crucial. Its results are a direct, timely proxy for U.S. consumer health, particularly in home improvement and the housing cycle. And analysts are paying less attention to the overall EPS number and are focusing intensely on two specific operational metrics.
Okay, what are those specific metrics we should be watching?
First is comparable store sales, or comps. This measures the sales growth only in stores open for more than a year. Any weakness here signals a fundamental slowdown in demand.
And the second?
Second, big-ticket transactions. These are purchases over $1,000, which indicate large consumer or professional contractor investment activity.
So weakness in either of those is a direct negative read-through for the broader housing market.
And a weak report from HD is a high-conviction short signal for the consumer discretionary ETF, XLY, as it signals pressure on one of its largest components.
And the second key report is Medtronic.
Medtronic, MDT. This report provides critical insight into the health of the medical devices space. Analysts will scrutinize this for commentary on unit placements and free cash flow. But the key metric to watch is guidance for the full year.
Any revision to their forward outlook is the catalyst.
Any revision, be it related to supply chains, hospital spending, or regulatory costs, will serve as an immediate catalyst, positive or negative, for the entire medical devices ETF, IHI.
So let's bring this all back home and synthesize the contradictory landscape we're navigating for Tuesday's open. Monday was decisively bearish and oversold. We had extreme sentiment readings like the TIR-AM at 1.85 and the PC ratio hitting 1.25.
But that GOGL surge provides a massive, fundamentally validated bullish counter-narrative. It injects risk-on sentiment right into the core sector that led Monday's decline.
So the market is at a genuine, volatile crossroads.
It really is. For you, the listener, the focus must be on the specific technical levels for the S&P 500, particularly in the immediate wake of those economic data releases.
What's the key level to watch? To stabilize the market and confirm the GOGL bounce has structural legs, the S&P 500 needs to reclaim and hold its immediate resistance level, R1. We define that as the zone between 6,669 and 6,707.
So the market can hold above that zone after the volatile 8:30 a.m. data?
It suggests the Buffett bump is overriding the structural rate fears.
So the key question you must be watching is this. Can technology's leadership recover and sustain itself despite the unresolved structural rate concerns, that higher-for-longer threat that drove the factor rotation on Monday?
Is this morning's action a confirmed buy-the-dip moment in tech validated by Buffett's signal, or is it merely a volatile gap-up that sellers will aggressively fade into?
That fundamental divergence megacap strength versus structural rate sensitivity is what will define this week's trading.
It is. Stay disciplined and watch those levels closely.
And that's it for this deep dive. Thanks for joining us on Bulls, Bears, and the Bell.
Stay informed and follow us to stay one step ahead of the market.
Until the next deep dive, trade safely.